Thanks for tuning in to this week's iteration of the Signature FD weekly investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start here with our chart of the week, and this one was titled, Is the Tech Sector in a Bubble? And our friends at Ned Davis Research wrote an interesting report trying to quantify how bubbly the tech sector actually is today in comparison to prior excess valuation periods, especially the late 1990s, early 2000s for tech. And so what they did was they created this chart here. So the tech sector has ran up about 175% in the last 3 years alone. That's about a 40% annualized return. And this chart here looks at different levels of valuation and then the forward 10-year returns from those starting levels of valuation. Now, it's a kind of an interesting valuation metric. It's called the excess cape yield. So what it does is it takes the inflation adjusted earnings over the last 10 years and divides that by the market price for the tech sector, and then it nets out interest rates. So it adjusts for the interest rate environment that we have today. And that yellow box that you see here, those are all the readings in the late 1990s, early 2000s, and the forward 10-year returns were negative, and in some cases quite negative, coming from that high level of valuation. Now today, you can see the black dot here that corresponds with the dashed red lines. That's where we are today from a valuation perspective. And that actually has corresponded historically to about 8.6% annualized returns net of inflation over the next 10 years. So that's a far cry from the 40% that we've been annualizing out the last 3 years, but not a bad outcome there. So their conclusion and ours as well is that the tech sector is not really in a bubble right now, just a little bit rich. Now, looking at market action from last week, it was a solid week in the markets. We got new year-to-date highs, you can see here, in both developed international markets and emerging international markets, as well as a new year-to-date high in the S&P 500. Small cap stocks and commodities are also participating in the advance. Bonds have been strong this year owing to falling interest rates, and the dollar has been lower. So those trends have generally been intact throughout the entirety of this year and continue to be built upon last week. Now, the major economic report last week was probably on inflation, and we titled this slide, we're saying inflation's edging higher, but not a problem for stocks yet. So the inflation report came in with inflation bumping up a little bit on a year-over-year change basis. You can see that inflation is sitting at about 3% right now. Inflation of 3% is higher than the Fed's target, but it is lower than the rate of inflation over the last 5 years. And historically, when inflation is lower than its average of the last 5 years, that's been a bullish development for stocks. So even though inflation has kind of stabilized and even started to turn up a little bit here, it's still far from being a major headwind for the equity market. Now, what we're seeing is quite a difference in the composition of inflation now. So this is just the year-over-year change in core CPI and that solid blue line. The dashed orange line is shelter. So that's inflation for shelter. And then the dashed black one is for services, X, energy, and rents. And they call that super core inflation. And you can see that super core inflation has ticked up a little bit lately, but it has generally been moderating. The CPI for shelter has been coming down at a pretty quick clip now, and shelter's becoming less of a tailwind to inflation. So that's a good thing for the overall inflation basket. But what you see here is that CPI for commodities less food and energy, you can think of that almost as like goods inflation, has returned to a fairly solid positive number here after being negative throughout most of 2024 and a reliable negative driver for inflation from about 2013 to 2019 or so. And what's going on here is tariff policy is starting to push up the price of core goods. But at the same time, you do have shelter rolling over. And so that's what the Fed is seeing. And the Fed thinks that this could be kind of a transitory move higher in goods inflation as the prices kind of adjust to the tariff mix. Now, when we look at earnings growth, and like I said, inflation is not really the market driver right now. So what is, and we think it's earnings growth. As long as earnings growth is positive, then the market should be able to continue on its bull market trajectory. So here, about 25% of companies have reported Q3 earnings so far. This is showing the growth rate by sector, and then also the gray bar is the index itself. And you can see that the index itself is up about 13% from an earnings perspective. That's a really solid number. We expect earnings to continue to kind of moderate, but remain positive. You can see really strong earnings driver from that information technology sector that we talked about earlier, utilities, which have been adjacent to the AI theme, especially the power generation, materials, energy, financials. And it's notable that energy has returned to growth in this last quarter. So when we think about the trend evidence itself, the corporate fundamentals are solid, inflation isn't much of a problem, interest rates have been coming down, and that's helping the market as well. Then it probably makes sense that the leadership has been pretty aggressive. So this chart here looks at the end of July as the starting point up through early last week. And you can see that unprofitable small cap growth stocks have returned almost 20% in that period of time. A really strong advance. These are stocks with negative earnings in the small cap sector have been performing really well, whereas profitable small caps are up a respectable 5.7%, but trailing unprofitable small cap stocks by quite a bit. So an interesting development. The market leadership has been aggressive. You can probably thank stable inflation, lower interest rates, and a resilient economy for that. All right, so our closing thoughts for this week is that chart of the week, the tech sector is far from cheap, but it is not likely in a bubble. We've got new year-to-date highs in large cap and international stocks. Small caps and commodities are also participating, as are bond prices. Inflation is higher than target, but relatively stable. It's not currently a threat to the bull market unless inflation were to really break out higher from here. Now, the composition of inflation is shifting, and the Fed's likely to look past some of that goods inflation and continue their easing cycle. Now, earnings growth for Q3 has been very solid, and market leadership has been aggressive. We want to continue to give the bull market the benefit of the doubt in this environment. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.